On January 3, 2026, at 2 in the morning, 150 American aircraft struck Venezuela. 3 hours later, Nicolas Maduro was in handcuffs on a flight to New York. 80 people died in the operation. 32 of them were Cuban intelligence officers embedded in Caracas. The United States military had just abducted a sitting head of state, transported him across international borders, and perp-walked him into a Manhattan federal courthouse. The strike was codenamed Operation Absolute Resolve. The justification was counter-narcotics. The result was the capture of one man and the collapse of an entire model of governance that had survived for nearly a century. This wasn't regime change for democracy or humanitarian intervention dressed in legal language. This was a financial execution. Venezuela had become insolvent, irrelevant, and expendable. The oil that once made the regime untouchable had become a liability. The debt that once seemed manageable had metastasized into $170 billion of unpayable obligations. The global energy market that once feared supply disruptions now shrugged at the blockade of an entire nation's exports. Maduro's capture wasn't just the end of one dictatorship, it was proof that the age of worshipped, oil-backed authoritarianism had reached its terminus, killed not by missiles alone, but by insolvency, energy transition, and the mathematics of irrelevance. For a century, oil provided a unique form of sovereignty. Regimes sitting on hydrocarbon deposits could bypass domestic accountability, ignore international norms, and survive sanctions that would collapse any other government. Oil revenue flowed directly to the state, eliminating the need for taxation and the social contract that comes with it. Citizens became subjects, parliaments became formalities, the military became the distribution network for patronage. As long as the barrels kept flowing and the prices stayed high, the model worked. Venezuela was the textbook case. In '98, Hugo Chavez inherited an oil company producing 3.5 million barrels per day. Petro-Dollar de Venezuela was the crown jewel of Latin American energy, a reliable partner for international oil companies, and a competent operator of some of the largest reserves on the planet. Chavez turned it into a slush fund. He created Fonden, the National Development Fund, in 2005. The fund was off-budget, meaning the president could spend tens of billions without congressional oversight. Oil revenue that should have maintained infrastructure or diversified the economy went to political projects, military purchases, and patronage schemes designed to lock in loyalty. Between 2005 and 2015, Fonden spent nearly $7 billion on the military. Venezuela bought 24 Russian Sukhoi fighter jets, sent cadets to Belarus for training, and placed military officers in control of 9 of 32 ministries. Health and education combined received less than $3 billion. The priorities were clear. Regime survival trumped national development. The oil wealth was being weaponized to create a fortress state where the military had a direct financial stake in protecting the system. This is the first mechanism that defines oil authoritarianism. Revenue decoupling. When a government derives its income from resource extraction rather than taxation, it stops being accountable to its citizens. In a normal economy, governments tax productive activity. Citizens pay taxes and in return demand services, representation, and competence. The government that fails to deliver loses legitimacy and eventually power. In a petrostate, the government owns the commodity. It doesn't need to tax the population. It doesn't need to provide good governance. It only needs to control the extraction and sale of the resource. This creates what economists call the rentier state. The government becomes a rent collector rather than a service provider. As long as oil prices stay high and production stays stable, the regime survives regardless of its domestic failures. Venezuela survived hyperinflation, collapsing infrastructure, mass emigration, and food shortages, not because it governed well, but because it controlled oil. The second mechanism is Dutch disease, named after the economic distortions that followed natural gas discoveries in the Netherlands during the 1960s. When resource revenue floods an economy, the currency appreciates. Exports in other sectors become uncompetitive. Manufacturing shrinks. Agriculture declines. The entire economy reorients around extracting and exporting the commodity while importing everything else. Venezuela followed this pattern to catastrophe. By the time Maduro took power in 2013, the country was producing almost nothing except oil. 96% of export revenue came from hydrocarbons. Food, medicine, machinery, consumer goods, all imported. The country with some of the richest farmland in South America was importing grain. When oil prices collapsed in 2014, the entire model imploded. There was no diversified economy to fall back on, no manufacturing base, no agricultural sector that could feed the population. Just oil wells, decaying refineries, and a bloated bureaucracy designed to distribute oil rent rather than create value. The third mechanism is corruption as structural necessity. In a petrostate, the government doesn't just tolerate corruption, it requires corruption to function. Oil revenue must be distributed to buy loyalty. Military officers get control of food imports and currency exchanges. Bureaucrats get no-show jobs and embezzlement opportunities. Business elites get contracts and monopolies. Everyone connected to the regime gets a share of the rent in exchange for their silence and support. This isn't incidental graft. It's the operating system. Venezuela militarized its entire economy to lock in this patronage network. By 2015, military officers controlled not just defense, but energy, agriculture, finance, and logistics. They weren't managing these sectors competently. They were extracting from them. The currency exchange system became a money-printing machine for insiders who could buy dollars at the official rate and sell them on the black market at 10 times the value. Food imports became a racket where military-connected distributors bought subsidized goods and resold them at market prices. The system wasn't designed to govern. It was designed to enrich the people capable of destabilizing it. Maduro's survival depended on keeping the military fed, and the military stayed fed by looting what remained of the state. But the model has a fatal flaw. It only works when oil prices stay high and production stays stable. Venezuela's production began collapsing long before sanctions. In 2000, the country produced 3 million barrels per day. By 2015, before the major U.S. sanctions took effect, production had dropped below 2.5 million. By 2020, it was under 500,000. The decline wasn't caused by lack of reserves. Venezuela holds the largest proven oil reserves in the world. The decline was caused by underinvestment, corruption, and brain drain. Skilled engineers left the country, maintenance was deferred. Profits were siphoned into patronage rather than reinvested in infrastructure. Wells that should have been maintained for decades were abandoned. Refineries designed to process heavy crude broke down and stayed broken because the spare parts budget had been diverted to political spending. When production collapsed, the regime lost its leverage. The global oil market no longer cared whether Venezuela exported or not. In the 1970s, disruptions from Iran or Arab producers caused global stagflation because supply was tight and alternatives were scarce. By 2025, the world had entered what energy analysts call the transition valley. Demand for oil is peaking. Renewable energy is scaling. Electric vehicles are becoming cost competitive. The geopolitical leverage that oil once provided has evaporated for mid-tier producers. Venezuela produced less than 1% of global supply by 2025. When the United States imposed a blockade in late 2025, oil prices barely moved. The market had priced in Venezuelan irrelevance. 17.5 million barrels sat immobilized on tankers, unable to unload because buyers had disappeared and storage was full. Wells shut down. PDVSA, once a reliable operator, became a hollowed-out shell incapable of restarting production even if sanctions lifted. The regime's only financial tool had become worthless. This is where debt becomes the executioner. By January 2026, Venezuela owed between $150 and $170 billion. $60 billion in outstanding bonds, 40 to 50 billion in bilateral loans to China and Russia, 20 to 30 billion in arbitration awards from expropriated companies like ExxonMobil and ConocoPhillips, another 30 to 40 billion in unpaid supplier arrears. The country's GDP was projected at 82 billion for 2025. The debt to GDP ratio had reached 200%. Venezuela was insolvent by any measure. Recovery would require haircuts exceeding 70% of face value. Even vulture funds, which specialize in distressed sovereign debt, knew there was no realistic path to repayment. The bonds were trading at 15 cents on the dollar, reflecting the market's assessment that the debt was essentially worthless. The complexity of the debt made restructuring impossible. A significant portion of PDVSA bonds were secured by a 50% stake in Citgo, the U.S.-based refiner that represented Venezuela's most valuable remaining asset. Legal battles over whether these bonds required parliamentary approval under Article 150 of the Venezuelan Constitution had paralyzed any attempt at negotiation. Creditors were split between those demanding full recovery and those willing to accept steep losses in exchange for political stability. China and Russia held billions in bilateral loans structured as oil-for-debt arrangements, giving them geopolitical leverage but no realistic hope of repayment. International arbitration awards from expropriated oil companies were piling up, with claimants pursuing Citgo's parent company in courts across multiple jurisdictions. The financial situation was a Gordian knot. No restructuring could satisfy all creditors. No Venezuelan government, opposition or otherwise, could generate the revenue needed to service even a fraction of the debt. Insolvency had made the regime ungovernable and the country uninvestable. The sanctions imposed by the United States in 2019 accelerated the collapse, but didn't cause it. Venezuela's economy had been shrinking since 2013. The 75% GDP contraction between 2013 and 2020 was the largest peacetime economic collapse in modern history, surpassing the Great Depression. Hyperinflation reached 130,000% in 2018. The minimum wage became worthless. A family needed 250 times the monthly minimum wage just to afford a basic food basket. 8 million people fled the country, nearly a quarter of the population. The humanitarian crisis was comparable to war zones. 70% of the population lacked access to health care. Hospitals ran without medicine, water, or electricity. Malaria, dengue, and yellow fever returned to regions that had eradicated them decades earlier. 31% of adolescents were out of school, vulnerable to recruitment by gangs and traffickers. This suffering provided the moral framing for the U.S. strike, but the operation itself was driven by financial and geopolitical calculation rather than humanitarian concern. Operation Southern Spear, launched in August 2025, marked the shift from sanctions enforcement to kinetic military action. The U.S. designated Venezuelan criminal organizations like Tren de Aragua and the Cartel of the Suns as foreign terrorist organizations, authorizing airstrikes on vessels suspected of drug and oil smuggling. By December 2025, 115 people had been killed across 35 strikes. The campaign functioned as an oil quarantine, targeting the shadow tankers and smuggling routes that served as Maduro's financial lifeline. The regime's remaining revenue came from discounted sales to China and opaque transactions involving stablecoins and front companies. The blockade eliminated even these marginal cash flows. On December 24th, U.S. forces struck a port facility inside Venezuela for the first time, destroying logistical infrastructure used for illicit trade. The escalation was deliberate. Each strike tested the regime's response capacity and signaled that the U.S. was willing to move beyond passive enforcement to active dismantling. Maduro's government could not retaliate. The military was fractured. Equipment was outdated. The Air Force couldn't contest U.S. air superiority. The Navy had no capacity to challenge American vessels operating freely in the Caribbean. The regime had no leverage, no allies willing to intervene, and no financial cushion to absorb further economic damage. It was a hollow state waiting for the final blow. Operation Absolute Resolve delivered that blow with precision. Intelligence from sources inside Maduro's inner circle, cultivated over months by the CIA, pinpointed his location to a fortified safe house in Caracas. U.S. Special Forces had rehearsed the raid on a full-scale mock-up. At 2 in the morning, the strike began. The initial bombardment disabled Caracas's power grid, plunging the capital into darkness. Helicopters carrying Delta Force operators landed in the blackout. The breach took minutes. Maduro and his wife Celia Flores were seized and extracted before the sun rose. The operation was over in 3 hours. The capture was not presented as an act of war, but as a law enforcement action under what Trump administration officials called the Monroe Doctrine, a rebranding of the Monroe Doctrine that asserts U.S. hegemony in the Western Hemisphere as both legal and inevitable. The rhetoric framed the strike as restoring order and combating narco-terrorism. The reality was a demonstration of unchallenged power. No international body could stop it. No regional ally could contest it. The United Nations condemned the action as a dangerous precedent violating sovereignty and international law, but the condemnation carried no consequences. Brazil and Colombia protested. Only Argentina's Javier Milei provided full support. The global reaction confirmed what the operation itself had demonstrated. The rules-based international order had given way to a deals-based order where power determines outcomes. Venezuela had no power. Maduro's capture became inevitable the moment the regime lost financial viability. The energy transition accelerated this inevitability. In the 1970s, oil disruptions caused supply shocks because alternatives didn't exist and demand was inelastic. Consumers had no choice but to pay higher prices and accept rationing. By the 2020s, the dynamics had reversed. Consumers were becoming producers through rooftop solar installations and electric vehicles with batteries that could provide backup power to the grid. Global oil demand was projected to peak by 2029. Investment in new fossil fuel projects was declining as financial markets imposed a climate risk premium on hydrocarbon assets. For oil-rich authoritarian states, this created an existential problem. Their reserves were becoming stranded assets, resources that must stay in the ground because extracting them would be economically unviable or politically untenable. Middle-income producers like Venezuela faced the worst of this transition. They lacked the financial reserves of Gulf states to cushion the blow. They lacked the governance capacity to diversify their economies before oil revenue disappeared. They faced significant revenue loss with fewer years to extract value from reserves before those reserves lost all market relevance. The U.S. strike was enabled by this lack of leverage. Venezuela couldn't threaten a supply shock. It couldn't rally other producers to its defense. It couldn't weaponize energy exports because it had none. The market recognized this. Oil prices fell modestly after Maduro's capture, not because traders feared instability, but because they anticipated that a U.S.-backed transition would unlock Venezuelan reserves and deepen the global supply glut. Former oil executives were already raising billions for investment, betting that the regime change would enable a sovereign debt, restructuring, and the return of international oil companies. But reconstruction faces staggering obstacles. Returning production to 3 million barrels per day would require $115 billion over a decade. That investment depends on legal stability, debt resolution, and a complete overhaul of Venezuela's oil law to allow private investors to take majority stakes. Opposition leader Maria Corina Machado had promised such reforms in meetings with U.S. officials before the strike, but promises and implementation are separated by years of political chaos. The immediate aftermath of the operation created a power vacuum. Maduro's loyalists remained embedded in the military and bureaucracy. Armed gangs like Tren de Aragua, which had coexisted with the regime, now operated without oversight. The risk of Venezuela becoming more violent and less governable than before was substantial. The humanitarian crisis persisted. Over 2.5 million people depended on aid that could be withheld during the political transition. The international community faced an ethical dilemma. Providing assistance unconditionally might enable spoilers. Withholding assistance would deepen suffering. The U.S. administration's stated plan was to run the country temporarily to ensure a judicious transition and get the oil flowing, but temporary occupations rarely proceed as planned. The Venezuelan people, after years of economic collapse and political repression, faced an uncertain future shaped by external actors with interests that might not align with their own. The capture also exposed the vulnerability of every remaining petrostate that has deferred economic reform. Russia, Iran, and several African oil producers watch Venezuela's fate with recognition. They face the same structural problems. Dependence on hydrocarbon revenue makes them vulnerable to price shocks and energy transition risks. Accumulation of debt during boom years leaves them exposed during downturns. Corruption and patronage networks hollow out state capacity, making diversification nearly impossible even when leaders recognize the necessity. The difference between survival and collapse often comes down to timing and scale. Larger producers with deeper financial reserves can weather longer transitions. Smaller producers with weaker militaries face the Venezuela scenario, where insolvency meets irrelevance and external intervention becomes viable. The Gulf states have recognized this vulnerability and are racing to diversify before their oil becomes worthless. Saudi Arabia's Vision 2030 and the UAE's pivot toward finance and technology represent attempts to escape the petrostate trap before the energy transition closes the exit. But diversification requires decades of sustained effort, competent governance, and massive capital investment. Most oil-dependent authoritarian regimes lack these prerequisites. They're locked into systems where changing course would destabilize the patronage networks that keep them in power. The result is paralysis. They continue extracting and spending while the world moves away from fossil fuels, accumulating debt that becomes unpayable as their primary revenue source declines in value and volume. Venezuela's collapse demonstrates what happens when this paralysis persists until the endpoint. The regime didn't fall because of popular uprising or military coup. It fell because it ran out of money and lost the leverage to resist external pressure. The oil that once seemed like permanent wealth became a worthless asset in a world pivoting to alternatives. The debt that seemed manageable during high prices became unpayable when production collapsed. The sovereignty that oil revenue once protected evaporated when that revenue disappeared. What remained was a hollow state, technically independent but functionally insolvent, waiting for the moment when maintaining the fiction became more costly than ending it. For the United States, that moment arrived when the costs of tolerance exceeded the costs of intervention. The refugee crisis was spilling into neighboring countries. The criminal networks operating from Venezuelan territory were destabilizing the region. The Russian and Chinese presence was expanding. The humanitarian disaster was creating moral pressure for action. The calculations shifted. An operation that would have seemed unthinkable during Venezuela's oil boom became viable, even attractive, once the regime lost financial relevance. The strike wasn't primarily about democracy or human rights. It was about managing the aftermath of a failed petrostate whose collapse was creating regional problems that intervention could potentially solve. The strike on Venezuela represents a historical inflection point, not because it was the first U.S. intervention in Latin America, but because it confirmed the obsolescence of the oil dictator model. The combination of insolvency, energy transition, and geopolitical irrelevance stripped the petrostate of its protective shield. Maduro's capture was militarily straightforward because the regime had already collapsed financially. The operation was geopolitically uncontested because Venezuela produced too little oil to matter. The international outcry was muted because the humanitarian disaster had already occurred. The age of oil dictators has ended not through sudden revolution, but through slow financial strangulation, followed by a final kinetic blow. The regimes that once seemed untouchable because they controlled energy supplies now face a world where those supplies are declining in strategic value, where debt has become unpayable, and where intervention carries fewer costs than tolerance. Venezuela's collapse is a warning for every remaining petrostate that has deferred diversification, accumulated unsustainable debt, and relied on resource rent to maintain authoritarian control. The mathematics of the energy transition are unforgiving. Reserves that seemed like permanent wealth are becoming permanent liabilities. The financial cushion that once absorbed sanctions and mismanagement has evaporated. Geopolitical leverage that deterred intervention has disappeared. What remains is insolvency disguised as sovereignty, waiting for the moment when external actors decide the cost of collapse exceeds the cost of intervention. That moment arrived for Venezuela at 2 a.m. on January 3, 2026. The age of the oil dictators didn't end with a dramatic finale. It ended with the quiet recognition that the model had become financially untenable, geopolitically obsolete, and strategically irrelevant. The future of resource-rich states will not be determined by the size of their reserves, but by their ability to diversify before those reserves lose all value. Venezuela failed that test. The capture of Maduro was simply the confirmation of a collapse that had been underway for years, driven not by missiles but by the cold arithmetic of debt, decline, and irrelevance in a world that no longer needs what the petrostate has to sell.